Hi, how are you? I'm Dan Whitaker, and this is Alex Sneed. He's a tax manager here at Whitaker. We just want to take some time and give you some tax updates and some stories that we're seeing and changes in tax laws that we're seeing with our clients. Hi, I'm Dan, and this is Alex. We're with Whitaker, here with a tax update for you guys. And today, we're going to go through really just a rapid fire tax update. And these are questions that we get consistently from our clients for different various reasons. So I just kind of wanted to cover them in one quick video for you guys. The first one is for 2022, the IRS mileage rate. So this would typically be how you reimburse your employees if your employees are driving, but it's 58.5 cents per mile. So that's the first one. The second one is the Social Security wage base. That's $147,000.
Why is this important? Why do clients ask about this?
About the Social Security rate? That's a great question. So the Social Security wage base, that's $147,000 is the max at which Social Security is taken out of the paycheck. Once an employee is paid more than $147,000, Social Security does not come out of the paycheck anymore.
Okay.
So a couple of years ago, actually not even a couple of years ago, I would say 15 years ago, the IRS did a study specifically related to S corporations in the Orange County area, and they were going after S corporations that were paying the owners too small of a salary to get around paying Social Security. That used to be a strategy.
Okay.
Right. That years ago, 20 years ago, that was a strategy. Let's set up an S corp. Let's pay very little salary so we don't pay Social Security. Well, the IRS did a study back in the late 90s in Orange County, and that's what they went after. So really the way I look at it now is if you have an S corporation and you're a shareholder in the S corporation and you're legitimately working for the business, you need to be paying yourself what the wage would be to replace yourself and or the max wage base, because at that point it's difficult to show that you're not paying the right amount. That's why that's important.
Got it.
The next one that we have on the list today is the 401k. The maximum 401k deduction for 2022 is $20,500. If you're over 50 years old, you can put in another $6,500. So anybody that's over 50 can contribute $27,000 to their 401k.
Are there any other benefits that can happen with this?
Yeah, so a couple of things that I would look at in that is if you have family members or spouses that are on payroll, make sure that you're taking advantage of the 401k deduction for them as well, right? I mean, this is the ability to put money away tax free, and that's just what we want to do. We want to max these out if we can. Something that I see quite often is a client will give us a W-2 and it'll show that their 401k deduction was, let's call it $18,000. Well, $18,000 was the limit a couple of years ago, and they've never gone back and updated that. So I think in their mind, they're putting $18,000 in what they believe is the max, and the max has changed, and they just haven't updated the paperwork with their 401k provider or their payroll company.
That makes sense.
Yeah, so making sure that you take advantage of that. The next one on the list is the gift tax limit of $16,000. I mean, I know for years it's been $15,000. It's now $16,000. So you can gift to anybody $16,000 on an annual basis without being required to file a gift tax return. So if you're married, that means you and your spouse together can give $32,000. So something to keep in mind. That's something that comes up quite a bit. Is what is that? What is that limitation? I can give them. It's $16,000 this year. The last thing that I want to touch on is the estate tax exemption. And the estate tax exemption is the amount that you are exempt from paying estate taxes on when you pass away or your spouse passes away. And it's the estate tax is not levied until the second person passes. As it currently stands today, if you're a single person, the first $12,060,000 transfers to your heirs estate tax free. If you're married, that's $24,120,000. And then anything over that's taxed at 40%.
That's a lot. That's a huge estate. Has it always been that large?
It's been that large and larger. Yes. Wow. At one point it was close to 50%.
Wow.
Yeah.
What about the exemption? I know 12 million seems like a really large exemption. Has it always been that way?
No, it has not always been 12 million. If we go back to, if I go back to when I started my career in early 1990s, it was $600,000 per person. And so there was a lot more of estate planning that was done when it was $600,000 per person to get assets out of an estate before people passed away to get around the tax, right?
Yeah.
There's a lot more estate planning done.
Yeah.
As it's ramped up and gone from $600,000 in the late 90s, it went to $1 million, and then it went up to a threshold. If you died in 2010, there was no estate tax. That was kind of the magic year. Hey, if you wanted to pass away in 2010, and there was no estate tax. But this has always been something that has been used, I believe, by the government to kind of manage the budget. So anyway, it's gone up, it's gone down, and I think what you might be alluding to, Alex, is the Build Back Better.
Yeah, I heard talks. I'm sure anyone who's read the news. Build Back Better bill in Congress that kind of got pushed to the side a little bit, but it's still kind of there. I think it's still part of the agenda, and this exemption limit keeps coming into focus. It's one of those things that everyone talks about, but they keep wanting to change. So why is that important?
Well, that's important because if the estate tax exemption is going to change and it's going to go down significantly, people want to start planning for that now and getting assets out of their estate now, doing their estate planning now, while they can transfer them tax-free.
Yeah.
It's it's very likely that it's going to sunset. It sunsets in a couple years, and it's going to go back to $5 million adjusted for inflation, which at this point is probably going to be $6 million per person. So, I think right off the bat, if the government doesn't pass any new laws in the next year or so on this, it does sunset and it does go back to $5 million adjusted for inflation. So it essentially gets cut in half. And I know that looking at our clients and our client base and the folks that we work with on a regular basis, they almost all have estates worth more than $10-12 million very easily. So these are things you want to do, and making sure that your will and your trust, especially your trust, are updated and you're taking advantage of the things you can, because the estate tax laws change, and it's important to have that looked at regularly.
And if you don't do it, you're up for about 40%.
If you don't do it, you're going to be passing a 40% tax rate onto your family for any amount over the exemption.
Wow.
Yeah, so it's pretty painful. It's pretty painful.
Wow.
So I think that kind of wraps up kind of our rapid fire update. If you'd like these bullet points, there should be a link in the video. Go ahead and download the bullet points, and let us know if you have any questions. Thanks.